Welcome to the weekly update, where I'll go over the action in the market for the week of December 26th through the 29th, and then we'll see how things look for the beginning of 2024 for the week of January 2nd through the 5th. We're fairly positive going into the end of the year. We had a down day on Friday, but the last 9 weeks have been up in a row, and that's pretty impressive. But we are looking overextended to the upside when we look at the short and intermediate term on our daily charts. We're even getting a bit overextended on the daily charts with our long-term indicators, and we're showing some more extreme positive readings when we look at the weekly charts. But for right now, things are still positive, but we're well overextended. We're also in a positive seasonality time where the January effect, which tends to help the small caps and even the mid caps, that didn't do as good this past week, but it has been pretty strong since we set the October lows. We're also in a period of time called the Santa Claus rally, which is the 5 last trading days of 2023 and the first 2 trading days of 2024. And from beginning to end, if they end up being up, there's a very high percentage of the time, I think over 80%, where the market tends to follow what happens in January. And we're also coming into an election year with the current president, at least at this point, will be running for re-election, and that tends to be a positive year as well. So there's a lot of positive things really happening right now, but we are overextended because there are also some negative things that are happening. It's never black and white. There's always some gray areas that we need to be aware of that the market can pick up on. There are geopolitical events that can happen that have an impact on the market. They can influence oil or gold or the dollar, and that can feed over into the stock market. Some event can happen that the market will react to. So we want to just maintain a real focus on the market, keeping an eye open for things that could be negative. Well, for right now, things are still looking positive, but we want to be realistic at the same time. Markets don't go straight up or even straight down. They have a tendency to chop, and we'll see if we're going to start to chop in the early part of 2024. What I want to say right now is Happy New Year to you. I hope 2023 was the best year that you've ever had. And get set, I hope 2024 is the best year, even to top that. I hope that the videos that you've run across that I produce are helpful to you. I'm very grateful. I've seen a lot of growth on the YouTube and Rumble channels, and I'm very grateful for that. I'm getting ready to roll out more of my program, which won't be necessarily offered for free, and I'll be changing some of the scheduling around. But it's been a real pleasure to get to know some of you that we were strangers just a year ago, and I'm looking forward to another year where I can meet more people and try to share with you what I know and see if that will be helpful to you. So Happy New Year to everybody. Some notes before I get started. I kind of alluded to this. I'm going to be rolling out some new videos in 2024. These will be more promotional. They'll generally be shorter, maybe 6, 8, 10, 12 minutes, where I just pick out something that's happening right now, and then I do a video about that. Now, these same videos I would include in the daily videos, but because people look at the length of my videos and they're like, oh my gosh, 30 minutes, 35, 40 minutes. I know, I want quick answers right now. I understand that, but at the same time, I'm not going to change how I do the daily videos because I believe we need to look at everything every day, and that's my approach. And a lot of the weeding out that I personally do is I don't want people that only want short videos to start to subscribe to the channel. I want people that really want to learn about the market and really understand what's going on and have a good, solid evaluation of what's happening. So I kind of went back and forth with these new videos. So they're more promotional, but if you're already watching the daily, weekly, and intermarket analysis videos, as well as the deep dive video, what I'm going to cover in these new videos will also be covered in the other ones. These are more just to entice people to watch the shorter video with the idea of directing them over to the longer videos. Also, as 2024 begins and starts to unfold, I have a whole program where I teach classes. I have a class on YouTube right now, which is just a basic stock market class. I have a full-length class on technical analysis. I have a full-length class on strategies, and I have a full-length class on mental analysis. that I'm going to be rolling out as we get going. And for the first couple of months of 2024, I'm just going to let anybody watch those that wants to watch them, because they're going to be more haphazard. Probably at about the beginning of March, that's when I'm going to start to lock things down a little bit more. And I'm also going to change the posting schedule. For example, whenever I get done with a daily or weekly video now, I post it right after, and anybody can go watch it. Well, for those people that are enrolled in the program, which will require a fee, it'll be $97 a month. I'm going to let those folks be able to have first access to the videos. And then near the end of the day, that's when I'll make the daily videos available. Because about half the people that watch my daily videos, they come and watch them after the market is already closed. Well, those videos are designed to be watched before or during the market session for which it was recorded. So I'll be changing that around a little bit. If you have any feedback, please let me know. If you want to leave a comment on YouTube or Rumble, if you want to send me an email, maybe you agree, disagree, what have you. But this is a business, and I've been posting these videos now for a while, and now I need to start shifting over to be more business-minded about this. Also, a PDF is available in the description below each video that I post. Sometimes that can be helpful to download it and follow along with the slides and the charts. Also, every day I update the pivot points. There are pivot points that apply just to the next day. There are pivot points that apply for the whole month, and I update those on the community tab on the YouTube channel. I do have a private Facebook group that you're welcome to join. That hasn't really taken off, and the back and forth is kind of here and then it goes away. What I'll be rolling out as part of my program is probably something different, like on Discord or some kind of a community type of area that you can go into, and I can post things and you can post comments. I'll also be posting videos that you can watch that I don't release on YouTube or Rumble, but yet members will still have access to. But for right now, if you want to join the private Facebook group, you're more than welcome to do that. I did just get done posting a poll for the upcoming week, and I'll be going over the results of the latest poll here in just a moment. And then what I'm doing now that we're getting to the end of 2023, I really watch the YouTube comments. And if they're garbage comments or crap comments or just they have nothing to do with anything, I delete those right away. There's also folks that post a comment that I really can't respond to. It's okay, I might agree with you, but I'm not necessarily going to say that, or I might disagree with you and I'm not necessarily going to say that. And so these comments just sit there. I don't like them. I mean, I don't hit the like button and I don't respond to them. Well, I'm going to go through and actually get rid of those because my list is getting kind of long and some of these comments are quite old. And I like to keep them up there. I want people to comment, but I don't necessarily respond to all of the comments that are made. So just be aware if you've posted a comment on some of the other videos and it's suddenly gone, it's not that I'm declaring war on you or I don't like your comment. It's just I need to clean up the page that I look at to make it more beneficial for responding to comments in a more timely manner. Also, I want to make another comment. This has been happening on Rumble, not so much on YouTube. I get these people that say, oh, great video, subscribe to your channel. Oh, I'm a YouTube promoter. I'm a Rumble promoter. I want to take your videos to the next level. I delete those right away. Number one, because the people don't watch the video. They're just trying to build their own business, and I can understand that. If you are actually listening to this and you are good at thumbnails or you have some insights into YouTube or Rumble or how to promote videos, send me an email. I'll respond to that. But if you're going to post a comment, it's going to get deleted right away. I do also post on Rumble, and here is the link. And I had some problems earlier this week. The YouTube video uploaded right away. It took many hours to get the video to upload to Rumble. And sometimes that happens. And sometimes that can also happen on YouTube as well. So just, I can't control that part of it. I can only do what I can do with that. All right, let's talk about the markets now. So for the week, we were up 0.32%. Not a real gangbuster week, but it was an up week nonetheless. We were below average with volume because we're in holiday mode. It's the slowest time of the year. Sometimes August can be really slow as folks go on vacation. Well, between Christmas and New Year's, it tends to be slow as well. We are positive with our technicals, but we're getting some really extreme positive readings on the weekly charts. We've also been getting some on the daily charts, but for the most part, the market is in a positive place for right now, but overextended to the upside because we're shifting the scenario now where for the last couple of years, especially year to year and a half, the focus has been that, oh my gosh, we're in an inflationary environment. The Fed's going to have to raise interest rates. Well, now that's starting to shift. As we're seeing inflation coming down, the Fed could likely be done raising interest rates, and we might actually be coming into an environment where they start to cut interest rates in 2024, and that's more positive, at least initially. Now, if it really keeps going down, that means the economy is falling apart and the Fed's cutting interest rates for that reason. But for right now, the economy still looks fairly strong. The employment situation looks pretty strong and inflation seems to be under control. And so that's a more positive environment for the Fed to come in and at least consider the idea of cutting interest rates. But we also keep an eye on all the different geopolitical events. We have a war still going on, believe it or not, between Russia and Ukraine, and it's getting worse every day. You just probably don't hear about it all the time. We also have what's happening in Israel, which may be expanding into a regional type of conflict. And then anything else that could come up at any time that could come in and have an impact on the market. And then the Fed, as they give their speeches, as they give interviews, as they meet, will be really in tune to what's going on there. And I explained this in the daily video, where most of the time that I've been involved in the markets for the last 30 plus years, it's been where the Fed follows the market. Well, ever since the COVID plunge, it's been the market following the Fed. Now that we're getting back into I don't know if there's such thing as normal anymore, but at least things are getting more friendly for the market as far as the economy and interest rates and inflation are concerned. Maybe we'll see a shift back where the Fed does start to follow what the market is doing instead of the market following the Fed. We'll only know that in hindsight, and we can only watch that over a period of time. All right, so as far as our trend, we are seeing a strengthening trend. Now, we're really extreme on the short-term and intermediate-term daily charts, and they're starting to roll over and go below their moving average. So we could see the beginning of a weakening trend after giving us a really extreme positive reading. But on the weekly chart, we're above the moving average, we're above 20, and the green line is on top. So we are positive for right now. Here's the week where the Dow was up 0.8%. We had the NASDAQ up 0.1%. The S&P was up 0.3%. And the small caps were actually down 0.3%. But they were doing a lot better earlier in December. So here are some comments that we can make about what happened. All the three major indices or indexes, depending on if you're from the UK or America, they closed 2023 with a 9-week winning streak. That's always a positive thing, especially when you look back to last October when the market was really going down and people were just, okay, this is the end of the world as we know it. The market's just going to keep falling. That's the problem that we run into. We think the way things are right now is the way they're always going to be. And you're going to hear me say that over and over again. When we're really going down, I'm looking for reasons why we could turn and go up. Right now, since we've been really going up, I'm looking for reasons why we might turn and actually start to go down. That has really helped me in my overall market analysis, and I try to make that point in all the videos that I post. Volume was well below average because of the holiday week. The S&P did get close to its all-time high of 4796.56, but it didn't get there. It was about 3 points underneath that. Now, the Dow did set all-time highs. The NASDAQ 100 set all-time highs this past week, but we have not seen that confirmed yet by the S&P 500. And small caps, they underperformed this past week, but my goodness, the small caps were up 12.1% in December, even with this down week that we just had. And since the beginning of 2023, the small caps are up 15.1%. Now think about that. That means they were up 3% until December. And then they gained the additional 12% just in the month of December itself. And that's what we call the January effect. Now we're trying to figure out, is that going to continue? Is it over? Is it going to fall through into more later into January than it's already gone so far up to this point? The S&P and NASDAQ did have gains of 4.4% and 5.5% respectively just in December. So December was a pretty strong month. And The NASDAQ was up 24 point, excuse me, the S&P was up 24.2% for the year. That's over double the average annual return. And the NASDAQ was up 43.4% for the whole year. That's a pretty stinking good year for a lot of folks that are perma bears, and they were just so sure that the market was going to fall off a cliff. Well, this kind of goes quite a bit against that. The mega caps, they were the best performers for the year. They were up 50.8%, while the equal weight, that's where we look at all of the stocks and they're treated the same. It still had a good year, but it was up 11.7% versus the 50.8% that we saw for the mega caps. But be aware of that. In 2022, it was the mega caps that were going down the strongest. So just because they're going up now, if we hit difficult times, they're probably going to go down the fastest as well. And then the 10-year note, believe it or not, a year ago, we were at 3.88% for the 10-year yield. We closed at 3.88% on the last trading day of 2023. So for the year, we're unchanged as far as interest rates are concerned. We did get up above 5% back in October. And as interest rates are going up, that's when stocks were under a lot of pressure. Interest rates topped out, stocks bottomed out, and everything started to reverse. And we've seen some pretty positive action ever since that point. And then I tried to find an updated version of this chart. I just couldn't. All I could find was this chart, a couple of other places. But what they're trying to do here is compare 1966 through 1982 with right now as far as CPI, which is the inflation rate that we're looking at. And we should go over here about to the end of 1976 if we want to try to line this up together. And have we bottomed out now as far as inflation is concerned? Because when we did bottom out here, then it started to pick up after that. We want to keep an eye on this. Now, are we going to stick to the same basic pattern? We don't know. We could continue to go down. We could deviate. We could go even higher. But for right now, we just kind of use this as a guide to look at. And then I'm only showing this now in the weekly video because we've dropped below the 4.02% for the 10-year yield. According to RenMac, when we're below that level, that doesn't really start to harm corporate profits. And right now we're at 3.88%. Here are the poll results as of last Friday. So as of a week ago, December 22nd, between now and the end of 2023, do you feel the S&P may fall from being overbought? It's been overbought for like over a month now. Or will it work off being overbought by going sideways or possibly wait to fall at the beginning of 2024? 18% thought that we were going to fall during the week. Well, we were up on the week. 45% thought that we would work off being overbought by moving sideways. And to a degree, that's kind of what happened. We didn't have a big up week. We had a lot of sideways action. And then there's still 36% that think that the decline is going to happen when we get into 2024. Then the S&P has now spent multiple weeks being overbought, and now we can add another week to that whole mixture. How do you expect this to play out with any new positions? 36% thought that they would still like to enter or establish new long positions. That's when you benefit when the market or whatever you buy goes up. Or they may establish short positions. That's when you make a profit when something goes down. And 64% were looking at establishing actual short positions. Now, I would not do that personally because there was really no evidence of that in our charts. I don't go against what the charts are telling us. I may think there are reasons why the market should fall. There have been reasons now for a month and a half to 2 months why the market should fall. We've been overbought. It just hasn't happened yet. Until I see proof of that in the charts, I'm personally am not going to initiate any kind of short positions. It can be very dangerous to front run the market. Wait until you see confirmation. That's where I come out. You may come out with a different angle on that. Then I asked, the transports and growth are lagging as the S&P has been climbing, and this is still happening right now. And I have another question in the poll for the upcoming week where I'm talking about the same thing. Do you find this concerning? 67% said yes, 33% said no. I think that's a concern, and we're still seeing that divergence, and it's getting even greater. The transports are really underperforming, and growth is really underperforming value as the S&P has been going up. Personally, I see that as a real vulnerability in the market. Then the week between Christmas and New Year's often sees well below average, which is exactly what happened. Plus, we have one less trading day. This can produce wild swings or muted price action. Do you feel that this action will be weak? This week will be wild or calm? 60% thought it would be wild. It was pretty subdued. There was one day when we saw some selling take place, but then we were able to get back to that. And 40% thought that it was going to be rather calm. All right, some charts. This is what I show. I update this every week. This is justifying prices going up because when analysts look into the future, whether they're at Morgan Stanley or the consensus of all the analysts, they are projecting that earnings are going to grow going forward from here. And that's why people buy low and sell high with stocks. They're not buying what the earnings are right now. They're buying what the future earnings are going to be. And as long as this red arrow keeps going up, that justifies higher prices. Then we have the Magnificent Seven. These are the big mega cap stocks. This is just to show you where we were at the beginning of 2023 and then how we've climbed and how we ended 2023 for the year. And they led things higher for most of the year. Now, over the month of December, we saw the small caps and mid caps really show some improvement. We've seen the equal weight index start to show some improvement, but for much of the year, they were really led by the mega caps. And then we want to keep an eye on this because, and I think I have this chart duplicated later on. This is the 10-year yield. And when it gets really high and tops out and then starts to come down, usually something bad happens. And we can go all the way back to the early 1980s to see when this happened. Well, we spiked up here back in October, and now we're starting to come back down. Is there something that we don't know about yet that could be under the surface, that could be brewing, that could be developing, that may hit the markets in 2024 that will keep interest rates going down, but not necessarily for the good reasons, because something bad is happening in the economy? I don't know about anything like that yet. You can watch all kinds of YouTube videos and everybody has their opinions, but until something happens that the market actually reacts to, it's all speculation at that point. Also, looking at this chart put out by Real Investment Advice, the chart that I show you has the equal weight and the S&P just about at the same level now, even though they're on different scales. This is a little bit more pronounced, where even though we're seeing more improvement with the red line, which is the equal weight index, it has been going up. But compared to the S&P 500, which is a weighted index, so the mega caps count for more, it's actually been outperforming when you look at this particular chart. Then we look at the share of 16 trillion in U.S. equity mutual funds. I talk about this in the class that I have posted on YouTube. And this kind of goes against the research that I talk about in that class. We have active mutual funds. And, you know, you read Forbes, you read these different financial magazines, Fortune magazine, and they have the rock star mutual fund managers. And so people read that, they see who's at the top of the list, and then they start investing in that mutual fund, only to get disappointed later because just because they had a 1, 2, or 3 good year track record doesn't necessarily mean they're going to be doing good going forward. That is an active mutual fund, meaning that there's a manager who's out looking for investments, who has a philosophy, who can buy and sell, possibly even go short at some points. And they're actually doing some research to find and uncover these investments on their investors' behalf. Those are active mutual funds. You take that against passive mutual funds, and that's what I talk about. This is when you have a mutual fund on the S&P 500 or the NASDAQ or the NASDAQ 100 or the Dow Jones Industrial Average or the mid caps or the small caps. There's nothing to manage there. Once the S&P 500 is changed or any of the indexes are changed, all they have to do is take out the old stock and put in the new stock. There's no research that needs to go on. And so we've seen a real gravitation of folks getting more into ETFs, which are also, they're like mutual funds, but you can buy and sell them during the day, where mutual funds, typically you have to put in your order before the end of the day, and then it'll calculate on the net asset value for that particular day. We're seeing a real move over into more passive investing. And that's been kind of the trend. As we have the internet, we have more information. You've got wonderful videos like what I put out there to try to help you. And so folks are more informed and they're liking the idea of possibly managing their own instead of turning the management over to somebody else. Then we look at the S&P performance. Okay, let me slow down. The S&P 500 performance at the start of the Fed cutting. And that's up in the air right now. Right now, the market thinks we could see some rate cuts as early as March. Well, what happens when they start cutting rates? A lot of that has to do with the reason behind why are they cutting rates? Is it because inflation is under control, or is it because the economy is falling apart and the Fed needs to cut rates to try to stimulate the economy? Well, right here in about the middle, this will be the starting point whenever they do cut rates, if that even happens in 2024. The median of all episodes, that tends to see some positive action after we see the cuts. Okay, but if we start going into a recession, meaning that the economy is under a lot of pressure, that's the light blue area here, and that could really see a real significant drain on the indexes. So it's just a matter of what's the context behind any kind of rate cuts that may happen. And then I talked about this in the video, the daily video for, I believe, Tuesday's session. This is some of my philosophy too. And I have to tell you a little story here. 20 years ago, almost exact, I was at some kind of a meeting where there was a person giving a talk. Well, it was October of 2003, and we were just going down the toilet at that time. And somebody giving the talk is not an expert about the market. Their expertise is in something else completely. And they were saying, oh, everybody's losing their retirement. Things are really in trouble. We need to be there and help them. People are going to lose their business, their house, all this stuff's going on. And one of the reasons he gave to justify things falling apart was that, well, the indexes they're artificially inflated to look good. And I'll finish that story by saying right at the end of his talk, he said, oh, by the way, this talk was on a Sunday evening. He said right at the end, call your broker tomorrow and sell all your stocks. I turned to a friend of mine that was sitting next to me and I said, we're at a bottom. And within 5 days of that meeting, we hit the bottom because these folks act out of emotion. And most of the time when you're in the market, it's not going to feel like the right thing to do. You're going to sell when you feel like you want to buy more. You're going to buy when you feel like you should be selling. Okay. And that's part of the overall dynamics of what's going on here. But what he was saying is, well, the indexes are inflated. They're not artificial. And instead of bashing that, I looked at that and I went, hey, I kind of like that. I like that the garbage is taken out and the good stuff is put in. I want to focus more on that. And that's when I personally changed from looking at individual stocks. Everything I do is based on the S&P 500, whether it's mutual funds, ETFs, options, strategies, either long, short, or I'm buying, selling, doing all different kinds of strategies. It's all around the S&P 500. And to me, it starts off with an evaluation of what is the S&P 500 doing? And then that develops over into the strategies that I end up implementing. But this just shows you over a period of time, those stocks that have been taken out and those that have been added, because the S&P has criteria. And I like that. There's some kind of levels that companies have to live up to be included in the S&P. And that means you're getting a little bit better quality in the index. All right. There wasn't any new FactSet earnings blog. They took the week off. This was the last blog post that they had, which was on December 18th. This is just showing that there's less than 1% growth expected when they're looking out for the current year of 2023, because we're still waiting for all those reports to come in. Then looking at our charts, here's the intraday chart. We started on Tuesday where we did gap higher. That's kind of a little Christmas present that was given. And we had a pretty good up day on Tuesday. We were pretty much sideways in Wednesday's action. We did gap higher on Thursday and then went flat. And then we did see some weakness after the open on Friday. But then it's kind of encouraging that we hit a low down here and we were able to bounce up off of that. So it wasn't all that great of a week, but this late day buying, even though there was some selling going into the close, the fact that the market is still wanting to rebound, that could be taken as positive. So for the week, and this is just the 4 trading days of the past week, the Dow was up 0.38% and all the other indexes ended up being down on the week for the 4 trading days. Now we can look at the full year where the NASDAQ was up the most at 53.81% based on this measurement. And all of the other indexes ended up being up the most, with the NASDAQ 100, NASDAQ, and S&P doing the best. The mid caps and small caps spent much of the year underwater. They saw a lot of their improvement come in December. Then when we go back to the all-time high, and it's been 500 trading days since we hit that all-time high, we now have the NASDAQ 100 and the Dow going above. Now, this is the all-time high for the S&P 500. We have not got back to that. That's this pink area here. We're about 0.5% away from that as of right now. But we are seeing some real improvement with the NASDAQ 100 and the Dow. We want to see eventually, and not necessarily right at the same time, but eventually we want to see all of these indexes being positive, and that would provide some confirmation to the market. Looking at the sectors just for the week, where we had staples, which has been under a lot of pressure, and utilities, which has also been under a lot of pressure, as well as healthcare, real estate, industrials. These have been the weaker areas in 2023. They performed the best over the previous week. Where discretionary, which has been a stronger area, that ended up being down. Energy's been all over the place. Sometimes it goes up, sometimes it goes down. It ended up being down the most. And here's the relative rotation graph. And you have to remember back to your geometry class where the line going from left to right, that's the x-axis. And when we're on the right side of the up-down line, that's a plus. When we're on the left side, that's a minus. And then we have the y-axis, which is the up-down line. And when we're above the x-axis, that's a plus. When we're below the x-axis, that's a minus. And the areas that are the strongest right now, we have the financials, and we also have tech. And they're green and going towards the right. So they're showing some strength. Communication, which had been a stronger area, it's been seeing a little bit of weakness. Where energy, it's been a lot of the year up here in the green area. It's been going all the way down here to the red area in the lagging parts. But we are seeing some more broad-based improvements when we look at the utilities even. When we look at real estate, they like the fact that interest rates are going down. When we look at the industrials, we're seeing a little bit of an improvement here with discretionary. We want to see that do better. That's one of the growth to value areas. And when we look at the materials as well as healthcare, they're showing a little bit of improvement, but they still continue to be negative for the most part. Then looking at the sectors, and this is just the 4 trading days that we just finished, we had healthcare, staples, utilities, and financials doing the best, with real estate also up a little bit, where energy, discretionary, and materials ended up being down the most. Going back 1 year now, where we've had tech, communication, and discretionary, they're positive on the year, where the rest of the sectors continue to be negative. And when we go back to the all-time high, 500 trading days ago, we still have energy, which is in first place, but it's given up a lot of its gains, followed by tech and industrials, where all of the other sectors in the S&P continue to be negative. Looking at sentiment, we're starting to get extreme. When we get at 75 and above, that means the party's a little too rowdy at that point, and it might be time to leave. So when we look at this on a historical chart, when we get above 75 and then start to come down, that is also feeding into this overbought condition that we're seeing in the market. And when you take all of this together, if we see some selling start to happen, it could really gain some momentum to the downside. But until we see that, we could continue to just party on like it's New Year's Eve. Hey, how you like that? All right, and then the active asset managers. This is another area. Even though these guys are professionals, and I say guys in a generic term, even though these folks are professionals, they're human beings. They have investors that they have to answer to. They have quarterly reports and annual reports that they have to send out to people and justify why I'm giving my money to you to manage it instead of me doing it myself. And so these folks have a tendency to react to what's happened in the market as well. And they're getting really extreme. We're above 100 now. Now, we could still go up a little higher than where we're at, but we're starting to use this now as a contrarian indicator. We're getting just a little too slap happy, at least according to this chart and our other sentiment chart that we look at. Here's another chart of the same thing where we're above 100 at 102.71. That's a very high reading. We also look at the VIX, which this measures fear. When the VIX is low, it's time to go. Well, the VIX is low right now. That's meaning there's not a lot of fear in the market, but it doesn't feel that way. We've been down here for quite a while now, and that's a little bit of a concern. We're getting to the lower end of the VIX, suggesting that people are just assuming that the market's going to keep going up. And you know what happens when you assume things. This is another fear gauge that we look at on a weekly chart. We're dropping off here with the Ulcer Index. When this is going up, that's when stocks are going down. When this is going down or sideways, that's when stocks have been going up. Then we look at the RIDEX bear bull ratio. RIDEX has some bearish mutual funds that you can get into. They also have bullish funds that you can get into. And when we get a real high reading, that's when the market is going down. When we get a really low reading, that's when the market's going up. And we came down to kind of a pretty extreme positive reading. We did tick back up just a little bit, but we've been lower than this before, but that was earlier on. That was back in 2021, the good old days when you just threw money towards the market and it magically doubled. Well, we went through 2023 that freaked out a lot of people, and so we're still seeing a little bit more nervousness here, but they're giving a pretty low reading overall. We have the I always say that. The American Association of Individual Investors, a week ago, they gave us an extreme positive rating. It dropped down just a little bit. So we're still coming off of using this as a contrarian indicator as it has been coming down. And then this is another form of a sentiment gauge that we look at. When the black line is going down, that's the tech sector, and that means that it's outperforming cash. You notice in 2022, cash outperformed the tech sector. You're safer to keep it in your pocket. Well, for 2023, this black line continues to go down. That's longer term positive for the tech sector and for the stock market. Looking at some economic charts where we have, and I don't think this was updated this past week, we have GDP now, which the latest reading has us a little bit up over 2% for GDP. That's not great, but it's not negative. So that still is looking fairly positive for right now. And then when we look at the top and bottom range of what the consensus is, it's about 1 3/4 or so to the upside and about 0.5% or so to the downside. But it's still positive for GDP. One of the definitions of a recession, including a bunch of other things, is that GDP is negative for 2 consecutive quarters. And we saw that before. And so now you're having a lot of people looking in the rearview mirror saying, we've already been through a recession. Well, according to other charts that we look at, we have not been through a recession. So, and I'll try to deal with that in some of the videos that I'm going to put out in 2024. This is a bar chart just showing the same thing where GDP for right now is still looking positive. And then this is the spread between risky and not as risky bonds. When this is going down, that means that there's not a lot of fear. When this really spikes up, that means that bond participants are freaking out. So the fact that this is declining is more positive. We look at the latest reading of the Chicago Fed National Financial Conditions Index. When this is going down, that's positive. When we get nervous is when we go above the red line. The latest reading, which is over a month old now, is the tightening standards that we see at banks. That has been decreasing slightly, but it's still quite high. Then we have the real-time SOM recession rule indicator. It's going up above the black line, but when we get nervous is when it comes up to the red line. Then we have the smooth U.S. recession probabilities, and this is above the black line too, but it's not up to the red line yet. So we're not really nervous about this. But that's kind of the debate that's going to go back and forth. Are we going to see a recession in 2024? Have we already seen a recession? Are we going to be able to have this soft landing with the idea that we're going to make it out okay without necessarily going into a recession? And then we have the Brave Butters Kelly leading index, where it is declining just slightly. This was updated right at the end of December. And the fact that this is coming down, when it goes up, that's when we really get nervous. The fact that it's coming down is more positive economically. Keeping an eye on inflation. And as the economic reports have been coming out, as the Fed seems to have shifted from a more hawkish stance to a dovish stance, we're seeing all for the PCE and CPI, we're seeing all these inflation figures starting to come down now. Keeping an eye on the Fed. This is as of Friday's close. There will be a meeting on January 31st, and as of right now, there's an 83.5% chance that they're going to leave rates unchanged. We are at 5.25 to 5.5, and that's where the market thinks they will be. There's 16.5% of folks that think that they may cut rates 0.25% at the meeting, and this will change every day. Now, the market does change every day. In the blue area here, this is what the latest reading is, and then we have a day ago, a week ago, and a month ago. And it's been coming down a little bit as we've been seeing a shift in some of the economic reports. But when we look out to the March meeting, there's a 72.8% chance right now that the Fed is going to cut rates 0.25%. This is going to change a whole bunch between now and then, but right now, the market is pretty optimistic that the Fed is going to cut rates. Then looking at the balance sheet, they said that they were going to start to deplete their balance sheet in June of 2022, and that's what they've been doing. The little spike up here that we saw was during the banking crisis in March of 2023, and this is the year-over-year change as things fall off of the Fed balance sheet. Then looking at breadth, we're still looking good on the weekly chart. Based on price and volume, we're above the moving average and advancing. This is showing good internal strength for the S&P. We're rolling over a little bit with our 4-week moving average, and our 10-week is actually starting to go down. That's because we're seeing more new highs than new lows, but they're starting to trail off. But this is still positive. Some of this can be attributed to a low volume environment that we've been seeing. But if we do start to break higher based on price, we want to see the new highs continue to go up. If that's not happening, that would be a negative divergence. And then we look at the advanced decline ratio, where we are declining, both with the 19 and 39 period moving average that we use, but we're still above zero. So we are still positive there. And accumulation distribution, we're looking good on the daily chart, but we're getting kind of far away from this red line. We're also a little bit far away here on the weekly chart. We're flattening out, but we still remain positive, and this is a smart money indicator. Keeping an eye on our trend. The black line here, that's the ADX. And then over that, I have a moving average to give us a general direction. When we're above the moving average, that suggests it's a strengthening trend. When we go above 20, that's also a confirmation of a strengthening trend. Then we look, is the green line or the red line on top? Well, the green line's on top, so we default to positive. The red line is on bottom, so that's why I don't have more of a negative stance. We look at the Erin indicator, which also tries to measure buyers against sellers. The green line are buyers, and that's all the way at the top. The red line are sellers, and that is decreasing. And so when you compare the two, the oscillator is above zero and advancing. That's positive. Mass index is not generating a signal right now. And then some other charts that we look at. This is a daily chart where we did have a down day. It seemed more pronounced. We ended up only being down 0.25%. But since we've been seeing really muted action, this looked like we fell off a cliff here. But for right now, we're still maintaining a pretty good looking daily chart. But on the bottom, you can see where we really dropped off. Even though volume picked up on Friday, it was still well below average. We're still above the midpoint of the trend channel going back to 2009. That means more of a positive stance. We finally broke above this pivot level. This is what we hit last July, and then we started to go down. We were able to break through that now, and this is looking more positive longer term. When we look at the trend longer term, the 50-week moving average, the red line is going up and price is above the moving average, so that is positive. We're also looking better when we do our moving average crossovers with the with the blue line above the red line, and price is above both, so that's still positive. We did decline a little bit with the McClellan oscillator. That's a little bit of a warning sign, but we're still above zero. And when we're above zero, that affects the summation index. And we're getting really stinking extreme here. We're also looking pretty extreme on the daily chart. And so that's a little bit of a concern. We're also getting extreme when we look at volume. We're starting to turn down on the daily chart. Sometimes that gives us a bit of a heads up. Other times that gives us a false signal, but we're looking extreme here. So that's a little bit of a warning sign that we're seeing. When we look at the Swenlin trading oscillator, we're above zero and advancing based on price and volume. You could see a little bit of a negative divergence here where the blue line's going up faster than the green line. And we're seeing a little bit of volume trailing behind price right now. And then the bullish percent index, and we see the same chart on the daily version of this indicator. We haven't rolled over yet. We're getting an extreme reading, and that's good. But when we start to come down, and if we drop below 70, that's an actual sell signal. And then when we look at the momentum, and this is the PMO, the price momentum oscillator, it's going up when we look at the indicator by itself. But we're getting extreme based on price. We're not quite extreme yet based on volume. And then we're seeing some negative divergences here with our studies where the PMOs that are rising has been dropping off as the S&P has been going up. We're also seeing the buy signals head lower as price has been going up, but we're still getting an extreme reading with the PMOs that are above zero. The percent B, after giving us an extreme reading, has worked that off now. This gives us a reading when we close either above or below the upper or lower Bollinger Band, and we closed inside of the Bollinger Band this past week. Then looking at our oscillators, where in the short term, we're still looking good. We're rolling over a bit on the daily chart, but we're still positive, but we're getting some really extreme readings on the daily chart here. But we're still looking okay, but getting extreme with the slope. The TSI is positive and not extreme. Then we switch over to the intermediate term with the MACD, which is still looking good and not necessarily extreme, where it is on the daily chart. The PMO is coming, it's not quite back up to this previous high, it's still positive. The PPO, again, not back up to this previous high and it's still positive. And then we have our longer term oscillators, the TRIX and KST, where they continue to be positive, and we're starting to get extreme with both of these, and we are extreme on the daily chart. So we're seeing some confirmation there, just things that are causing us some concern. When we look at the Chaikin money flow, we're getting a very high reading right now on the daily chart. We're still looking positive here on the weekly chart. And the Chaikin oscillator is actually dropping down on the daily chart, where after getting extreme positive here on the weekly chart, it's starting to come down, but it's still extreme positive. The force index has been declining, and we're seeing a bit of a negative divergence there on the daily chart, but it's still positive because it's green and above zero. We're getting a really high reading with the money flow index or money flow indicator. That's another warning sign. And the rate of change going back 1 week since we had an up week, we're above the midpoint. When we go back 50 weeks, we are coming down just a little bit after giving an extreme positive reading. This compares this past week with 50 weeks ago. And then where are we in relation to that? And it's coming down slightly. The RSI based on 14 weeks, we are positive and we're not getting an extreme reading, where we're coming off of extreme readings with the charts that we look at in the daily version. The weekly chart of the the weekly chart of the special K continues to be negative, but it's starting to turn up. The daily chart continues to be positive. The Stochh RSI is still extreme positive and has been pegged there for the month of December. The Williams percent R is also extreme positive. The ultimate oscillator is giving us an extreme positive reading, and the vortex has the green line on top. This is kind of confirming what we're seeing on the daily chart. They're both advancing and not necessarily extreme right now. The Copic curve continues to be positive. We're also seeing a positive sign on the daily chart. And the next level that we're kind of dealing with now is the all-time high. And we have not been able to come back to that level, at least yet. Our different charts, we're looking good with the Heiken Ashi weekly chart. The Kegi chart is black and pointing up. That's positive. The Renko chart is positive, and the three-line break chart is positive. We have the ease of movement, and there are really two different indicators on this chart. This is an equivolume on top. When it's green and thick, that means it's up on high volume. When it's thinner, that means lower volume. When it's red, that means we were down. I mainly look at the 14-week where we're above the midpoint and advancing, so that's longer-term positive. We didn't have anything new drawn in the point and figure chart. We didn't have enough of price movement to generate that. And one more X up here would come back up to the all-time high. The last pattern signal that we received here was on November 20th, where we had a double top breakout. Then we're looking okay still with the Elder's Impulse system for the S&P, where we're neutral right now with the daily charts. And we're still positive with the parabolic SAR system that we use. It's positive on the daily charts and positive here on the weekly chart with the dots underneath. With our longer term PPO studies, we're still looking good as we're going up in the long term, intermediate term. We're declining a bit in the short term, but we're still positive. And then I pulled out a few charts that I used in the daily videos because as much as I'd like you to watch the daily videos, I'm a realist, understanding that you probably can't see those every day. So I pull a few charts out. To me, this is a pretty big concern. As the S&P has been going up, we've been seeing the growth to value ratio going down. And we want to see the growth to value ratio going up. And that's just not happening right now. We're wondering if there's going to be some kind of a reckoning as we get into 2024. Either the growth to value ratio is going to have to start to go up, or possibly price is going to have to start to come down. We're also getting a little nervous here with the VIX to S&P 500 correlation. We didn't get quite up to an extreme reading here, but we got close. And now we're starting to come back down. And if you look at other times when we spiked and started to come down, that typically marked either a short to intermediate term top in the market. We don't know if this went high enough to generate a valid signal or not. So we kind of have to wait and see how that plays out. We're also going to be starting a new 50-day cycle. Now, I don't know if this 50-day cycle is going to work going into 2024. The market environment is shifting. Is it going to be a different day cycle? But for right now, the last year or so, this has been rather helpful. Sometimes it's irrelevant, but we will be starting a new 50-day cycle on January 2nd, right when everybody comes back to start 2024. This is another warning sign that we're seeing. The Dow is breaking out and setting all-time highs. The transports are declining and have not even been able to get back to this previous high. In a more solid environment, we want to see the transports doing better than they've been doing, and that's not happening. That's a concern. Then when we look at seasonality, 80% of the time, December tends to be up. And that'll figure in now for 2023 because we had an up December. And then just looking at this chart here with the S&P, this is the small caps, mid caps, and S&P itself with really no studies put on here. We haven't come back to the all-time high yet. We're showing a lot of improvement with the mid caps, but still have not come back to the all-time high. Showing some improvement with the small caps and have a bit of a further ways to go to come back to the all-time high. But when we look at the Dow, it is setting all-time highs here and in an uptrend. The NASDAQ continues to be in an uptrend, still has the ways to go to get back to the all-time high, where the NASDAQ 100 is just kind of kissing into new all-time high territory and is still in a strong uptrend. Here's a weekly chart with, I'm showing the QQQs, which is the ETF for the NASDAQ 100. This did, even though it closed down a little bit on Friday, it did set a new all-time high multiple times this past week. The mid caps are just about getting ready to give us a golden cross here and showing some improvement. The small caps have a little bit further to go to give us a golden cross with the trend, but they are showing some improvement at least up to this point. The NYSE is also turning back more positive. This is a broad market measure. All stocks, also another broad measure, continue to show a lot of improvement. Not quite back to their all-time high yet. The 30 biggest software companies are turning back more positive. We're seeing the blue line coming back above the red line. The FANG index set an all-time high earlier in the week, but it has dropped off just a little bit. ARC is showing some improvement and isn't a longer-term uptrend, but it has to go up like about 300% to get back to its all-time high. And then when we look at the banks, they're showing a lot of improvement, but we're getting extreme with the weekly version of the RSI on top. We're still positive when we look at the weekly momentum, and the price chart itself is showing some improvement here. When we look at the deposits, we're still seeing net outflows here. When we look at it year over year, people are still having a tendency to take their money out of the banks. And then this is just a blanket vanilla chart of Dow theory, where we're going to new all-time highs with the Dow. We're not even coming back to previous highs with the transports. And the utilities tend to follow interest rates, and that's why they've been under pressure lately. Traditional Dow theory really just uses the Dow and the transports together. I like to include utilities in here just to get a different perspective. Looking at the broad market, we have the CRB, which is still in a longer-term uptrend, but that could be in danger of seeing a death cross here as we're seeing some weakness in commodities. Oil is still dancing around the 70 level. It spiked up earlier in the week. There was something that happened near India where Iran shot something in a ship and oil spiked up and then came back down. When we look at copper, and this looks at the economy, when copper's going up, that means the economy is generally perceived to be looking better going forward. It is still in an uptrend here and showing some improvement, but we want to see this continue longer term. And then the dollar, and if we do see stocks continue to go up, we're likely to see the dollar continue to go down. The stock market tends to like a weaker dollar. When we look at gold, it's still, now I just look at the ETF. There are other indexes that have us at like 1 billion right now or something, but we're well under 2,000 here, 191. When you look at just the ETF itself, and this is a little bit concerning. We're not necessarily showing a breakout right now. I know there's a lot of people out there that just swear by gold. Well, I'm one of these people that kind of swears at gold because it's like, okay, it was supposed to be at the moon by now, and we haven't even got off the ground yet. Then silver also showing a little bit of improvement, but has pretty much been chopping sideways. When we keep an eye on bonds, we are seeing an improvement when we look at price, and we're getting close to seeing a golden cross. We're turning down just a little bit with our monthly chart of the stock to bond ratio, but we're still showing that stocks are outperforming. This is another concern, and I keep showing this in the daily video because it's strange. When we take the 1 month yield and subtract the 3 month yield, naturally, logic would suggest we get a negative answer. The longer term yield should be 3 months, should be higher than the 1 month yield. We've been getting a positive result here. That's another thing. It's like, is there something going on that we're not being told? Because earlier in the year, when this gyrated all over the place, that was when they were having the debt ceiling debate and the whole crisis. And oh my gosh, everything's going to end as we know it. Well, is something happening here to actually cause this? I have not been able to find any information, at least yet. For right now, we're just watching the chart and paying attention to this. This is another chart of that same thing, where longer term, we're seeing the 1 month yield actually get higher than the 3 month yield as these lines start to cross. We did see this last spring during the whole debt ceiling issue, and now there's just something weird about all of this. It shouldn't be playing out this way. When we look at the daily chart of the yields, we are seeing declines overall. Here's a weekly chart for the US, UK, and German rates. They are continuing to decline, even though they tick back up. Japanese rates are also continuing to decline, and I'm keeping an eye on what's going on in Japan. And if that breaks, I'll be doing lots of videos and I'll be talking about it. And then this is that same chart. So I did show that earlier on. Some relative studies. Here's our intermarket analysis, just as for the year now, where stocks performed the best, followed by gold. And then we had the dollar and then bonds, where energy ended up being down. If you go back to the beginning of the year, oil ended up being down. This is going back to the all-time high, where energy is still in first place, where you've got the dollar and gold kind of kissing each other here. Stocks are starting to turn more positive, and we're still negative with the price of bonds. But when we look at some ratios between the NASDAQ 100 and the S&P, they're both doing really well, but the NASDAQ 100 is doing even better. The S&P 100, this is another concern, and I brought this up last week, and we're still seeing some more follow through here, where the 100 stocks are starting to underperform on a short-term basis, the 500 stock, or all the rest of the stocks in the S&P 500. Is that a concern? Is this just a more short-term anomaly as the rest of the stocks in the S&P 500 start to show some improvement? We want to keep an eye on this one. The growth to value ratio, this is another concern. We're seeing a longer-term uptrend with growth when we compare it to value, but lately it's been going down. We want to see this really going up to give more support to the S&P 500. Gold is still underperforming the rise in the S&P 500, even though gold goes up and comes down and does what it wants to do. Gold has been going up as the dollar's been going down, so we're coming up to this other longer-term trend line. And bonds continue to underperform stocks on a shorter-term chart. The low volatility stocks are really breaking down now, and we'll probably see this. I shouldn't say that. I don't like to be real dogmatic about things. If the economy continues to show some improvement and interest rates are coming down because inflation is under control and the economy is not falling apart, we're probably going to see this ratio continue to go down. Then discretionary to staples, it's still showing that discretionary is outperforming, but we want to see it doing better than it has been. And energy is underperforming when we compare it to the tech sector. And then longer term, we had this initial buy signal that was generated in October of 2022, so over a year ago. And this tends to be indefinitely on the books, and it tends to have a perfect track record going forward if you're willing to wait long enough. This is one of our long-term charts that we look at. Another long-term chart is called the Zweig NYSE Breadth Thrust. Marty Zweig wrote one of the very first books that I read when I started to get into the market. He's since passed away, but after a lot of research, he came up with what's called the Zweig NYSE Breadth Thrust. And when you get a really low reading, and then in a short period of time, you get a really high reading, that tends to mean that things are shifting. Well, we saw one of these signals generated in March, and to see any of these signals is very rare. And now we just saw another one that was generated at the last part of October. To see two of them so close to each other is really, really rare, but also could be longer term positive for the market. We also have the Zohorchak method, and I have the wrong version of this chart. The highlight should be down here in the middle. It was looking more negative. We got down to a -6, and now we bounced up to a 0. So that is an improvement, even though we're at the neutral reading. And then longer term, this is a trend line going back to the 1987 crash for the S&P, and just seeing where are we at now. We're above this longer term trend line. This is a shorter version of that same chart, just going back to 2018, where we still are above this. If we continue to go up, that would be more positive. If we start to fall, will this provide support? There have been some other times when we got faked out here. Now, I will tell you, if you're a doom and gloomer, or if you listen to those folks, this is where I got the idea for this chart from, because we come really close up to this point and they're just declaring the end of the world. Well, it doesn't necessarily mean that. We could still look at this in a positive way. We just want to be aware of this at the same time. Also, the same idea here. This is a weekly chart of the NASDAQ 100. We're coming right up to the trend line itself. Is that going to provide resistance? Is that going to provide support? Right now, it's too early to tell. We don't want to declare the end of the world, but we don't want to say party on forever either. And then we look at a ratio between the NASDAQ 100 and the Dow. We're coming close, but we're not quite back up to this previous ratio level. This is where we topped out in the dot-com boom and then bust. This is where we topped out in 2021 and then bust into 2022. We haven't quite come back up to this level yet. Then we look at the QQQs to the small caps. This is a little bit of a concern when we look at this ratio. It got up high and now it's starting to come back down. Now, it turned up in this past week, but we're going to want to keep an eye on this. If this continues to fall, that could be longer term negative. And then we're keeping an eye on the cumulative new highs, new lows for the NASDAQ. They're turning up ever so slightly after going down for many years now. That's because when we take the raw score, the new highs minus the new lows, we're above zero. The longer we can stay above zero, the more this cumulative chart is going to turn more positive. And then we're looking at the 3-month yield. We don't know if this is even relevant. It was back in 2007 when we topped out and then started to come down. That was the great financial crisis. We actually went above that level, and now we're starting to come back down. Is that, if this continues to fall, is that meaning that something bad is going to happen economically? We don't know at this point. For right now, we just want to be aware of this and keep an eye on things. So now I go back over to the daily slides and I just show the outlook that I have only for Tuesday's session. Please be aware, this probably goes without saying, but the markets will be closed on Monday for New Year's Day. We are in the middle time now where they start counting a thing called the Santa Claus rally. There are still 2 trading days left. We're also in that period of time where we're wondering if the January effect, which helps the small and mid caps, if that's going to continue. Not really any earnings that I could see are coming out. On the daily charts, we're still positive, but we are very overbought, and we've been overbought for quite a while. We'll get the S&P Global U.S. Manufacturing PMI. That's not really an influential report. We're also going to get construction spending in Tuesday's session. And then we want to keep an eye on all the different geopolitical events, especially over a holiday weekend where you have Christmas, you have the Spring Festival. Those are more centered around different civilizations, where the whole world tends to celebrate New Year's. So we'll have to see if that even means anything. Then here's the economic calendar for the upcoming week. We're going to get ISM manufacturing on Wednesday. That's a big deal. The FOMC meeting minutes are going to come out also on Wednesday. And then we're going to get the employment situation report on Friday, as well as the non-manufacturing PMI on Friday. So we have some pretty influential things coming out in the upcoming week. Then some seasonality, and I still forgot. This should say January right here. It says December. 2024 follows January 72.6% of the time in a presidential election year. So we've already got whatever happens by the end of January, we have almost a 72.6% chance that the market's going to do what happens in January. And then we also are wondering, is the January effect going to continue? When we take the last 74 years, we're up 59.5% of the time. We're down 40.5% of the time. I'll talk about the options expiration. That's coming into the 3rd Friday of the month. But then when we look at just January 2nd, we're positive across the board with the Dow, S&P, and NASDAQ. So folks tend to start off with some optimism, at least in the 2nd, because we're always closed on the 1st. So this is the first trading day of the year. Then we'll be watching this as it unfolds, where we do see the green dashed line. That's the S&P during an election year. We do see some positive seasonality for this day. Then this has been updated as well. Wednesday tends to be the most negative day, where Monday and Fridays tend to be the most positive. This is as of 2023. We don't know if it's going to continue like that in 2024. We could just go with what's already happened. We're also wondering if the January effect, which is when small caps outperform the large caps, it's been hanging in there. And that typically, according to this chart, lasts up until about the middle part of January. And then we're also comparing 1982 because we saw some similarities with 2023 where we went down and then we started to go back up. Does that mean we're going to go up in 2024? I use these as guides. I don't use them to make decisions because about the time you do that, these things get out of whack with each other. Because if you take enough different patterns and throw them all together, you can say whatever you want it to say. Then looking at the seasonality, and then this is for an election year where when the current president is running for re-election, we tend to start off more sideways when that happens. When it's just a regular old election year, we tend to see things start off more positive, but then they're both showing positive seasonality for the whole year. This is the chart of the 4-year presidential cycle where we're coming up now into 2024, where we do see a little bit of sideways action, but overall we tend to see more positive seasonality. And this comes from the Stock Traders Almanac book. I would really, really recommend that. I don't get a commission. I'm not connected with them in any way, shape, or form. I just think that there are tidbits of information. Instead of using this, well, let's shift it ahead 1.5 months, or let's compare this year with the other year, I think seasonality is a pretty good guide to use. It doesn't mean things are gonna unfold exactly that way. I think it is more reliable and we can put more confidence in it than just coming through this arbitrary shifting around of different charts. But that's my stance on things. So I would really recommend. You can get it in Kindle form on Amazon. You can also get it in spiral form. And again, I don't work with the company or anything I get nothing in return. I would just really recommend that. And there'll be a description. In the description, there'll be a link to the book on the Amazon. And then when we look at the seasonal pattern from 1949 to 2022, that's the green line here when the current president, at least as we know right now, plans on running for re-election. And so that tends to be positive for that year. Then the scenarios. We're not going with the down one right now because we just don't have any evidence of that. We will go with the up scenario, but we're overbought and we're overextended and we're seeing lots of negative divergences. And we're also concerned with our trend because we're getting really, really high readings that are starting to roll over now when we look at our ADX in the short term and the intermediate term. But if anything, we would still default to the positive side. At least that's what I would do. The warning signs. We are really concerned that growth is not participating in the advance that we've been seeing. The longer-term 5-period equity put-call ratio is going back up. Now, was that because of pre-holiday hedging? Was that because we're overbought and you've got folks that see that and they're starting to hedge in case we start to go down? Or is it because of seasonality? We're coming into the end of one year. We've got a number of holidays, and now people will be coming back and they just wanted to have some more hedging on their positions. We don't really know about that, but that could explain why this is going up. When this is going down, that is more positive for stocks. And the transports are negatively diverging from the Dow. That is a concern as well. The 1 to 3 month short-term bond spread, I showed you a couple of charts, that continues to be positive where it should be negative. Then longer term, with those weekly charts with the NASDAQ 100 and the S&P, we're right near those lines now. And we don't know, is that signaling a top? Is that going to provide resistance? Is it going to provide support? This has been playing out for a while and will probably continue to play out. The cumulative new highs, new lows for the NASDAQ, they're still weak, but they are starting to turn up and showing some improvement. The 3-month yield, like I showed you in the chart, it's above where it was back in 2007, and it's starting to roll over. We don't know if that's relevant or not. And then earnings as they are released. Positive signs, and the list is kind of long here. The daily special K chart is positive, where the weekly chart is still negative. Longer term, our equity put call ratio continues to go down. That's long-term positive. The risk on posture is showing some improvement. That's positive as well. Our oscillators on the daily charts, they are positive, but giving us extreme readings pretty much across the board. The parabolic SAR and vortex indicators, and I tend to use both of these pretty heavily, they continue to be positive. The bullish percent index is positive, but it's extreme positive, and to this point has not started to roll over yet. The Kopit curve is positive. The Zahorchak method is showing some improvement. And now, for the first time in quite a while, we're seeing golden crosses on the Russell, the small caps, and the mid caps. Small and mid cap growth is not doing all that great. It's chopping sideways. Small caps are near the bottom end of their range, where the mid caps are near the top end of their range. And if we're seeing any strength right now, it's coming from the mid caps, not necessarily from the small caps. The financial sector has been showing a lot of improvement lately, and our longer term new high, new low study continues to be positive. Long term, we have multiple ZWAG NYSE breadth thrust buy signals that were generated over the last 12 months. That's very rare and very positive. Seasonally and historically, January tends to be positive during an election year when the current president is running for re-election. The longer term seasonality and setups, those are still further in the background, and I tried to show some charts there. So our conclusion just for Tuesday is that we're positive and overbought, and we say that on all the different time frames right now. We want to see price prove itself before we're willing to go long. If things start to turn more negative, we want to see that be proven to us before we're looking more negative on things. That's my conclusion that I reach. Thank you. I hope you found this helpful. I have no idea how long this video was. It's probably a lot longer than usual, but hey, it's the end of the year, beginning of the year. I figured I'd go a little extra on this. I want to wish everybody a very happy New Year's and a great 2024, and I will talk to you in the next video.